About to start. Super excited. We are right now
Are you ready?
on. Yes, we are. We are born ready. So we are on YouTube Live on my YouTube channel. For those that are watching, thank you very much. For those that subscribe to my channel, thank you very much for following me, subscribing, and sharing all this great content. But the main point is we are also on another platform right now, BTP, Bukharians Also Cry. That's a great platform, which is a closed Facebook group that is designed and really out there for our community folks that are really following this group for many, many years. And right now we grew to 30.3 thousand people. So it's
Wow.
30,000 plus people that will get notification about this live. And we will have the privilege of sharing our knowledge and experience. And I want to welcome you both into Kaikov Media Studio and Olga Zakinova podcast. Super exciting, super honored to have you both here. Thank you very, very much for taking the time to take it out of your busy life and schedule and to really dedicating this moment to sharing every single bit and piece of your wisdom, knowledge, and expertise with those that are watching us. So without any delays, let's begin. Sam and Peter, present yourself, and I want my audience to know exactly who you are and what you do.
Okay. Olga, thank you very much. I want to start off by saying thank you for having us here. It is an honor for us to be here. We have watched many of your podcasts. You do a great job. You give a lot of great information to people out there. So without further ado, my name is Peter Lucia. I'm with CrossCountry Mortgage. I'm a senior vice president. I run the largest team at CrossCountry Mortgage. We're $1 billion team. We've been $1 billion team consistently for the last 5 years or so. And it's great to be here.
Awesome. Welcome.
Nice. Thanks for having me back, Olga. It's great to be back.
Welcome back.
That means,
Sam,
that means I did okay the first time, so I'll take it.
it is my honor
Yeah,
to welcome you
so-
back.
For those of you that may or may not know me, Sam Mogavero with Cross Country Mortgage. I am a loan officer with the company. Like Peter said, one of the largest teams at Cross Country Mortgage. We did over $1.5 billion in home loans last year, I think, residential, something like that. So it's a pretty big number, a lot of responsibility. It's kind of why we're here today to talk to you about what goes into that, some tips and pointers for people, and we'll kind of dive into it. So thanks for having me back. Appreciate it.
Awesome, awesome. Well, let's begin, guys. Straight to the point of how's the market doing today? What's going on with interest rates?
Okay, let's talk about interest rates. So in today's time, I mean, the market is always moving, but today the rates are in the high sixes on most occasions, on most loans. Some jumbo loans are in the low sixes. Unfortunately, this is about a 50 basis point increase from about 30 days ago. So the rates have gone up a little bit. They flared off a little bit. We came back down, but they're still on the higher side for this year, with some hopes that they will go down in the near future.
Should buyers wait until the rates go down to buy the property?
That's the magic question, right? Should you wait to buy a home?
I was waiting to ask you this
Yeah,
question.
you were waiting for
long
me to say that question. I'm going to turn it to you for what do you think buyers should do right now as a real, and then I'll go into the mortgage side of how I feel about the finance part of it. But
Well, first
What's-
of all, I think we are super blessed that we are living in the country and the state that is so consistently, naturally, and organically appreciating. I think you and
I would
looked-
agree with that.
I think you and I looked up the information yesterday.
Yep.
That my curiosity always like, hey, what's going on with appreciation?
Yep.
Like if I just bought something right now today and didn't do nothing, what would be the organic appreciation over the years? And year after year after year, share with the listeners, what did we pull up?
Yeah, I mean, think about it this way. The only time real estate has ever devalued is 2008.
Mm.
So think about the stock market, right? All those cyclical time frames in which it goes up and down. But the real estate has only been, 2008 was the only time it ever declined. So think about it this way. You're purchasing something that 9 out of 10 times will increase in value. I mean, I think a lot of people would agree with that. I mean, obviously we're saying that because we're in this business, but it's a fact, right? You can look it up. We looked it up yesterday. I think we said like 20 or 30%
Yeah.
in New York. And then the national average was somewhere around like 4 or 5%. So if you buy something for $1, you're making 25 cents on that dollar, right? Roughly, which is great,
It's awesome.
in my opinion.
It's awesome, but look what's happening with rentals, right? Rentals are the driving force why people want to save and buy.
I agree. Because the stability there, right?
What did I tell you earlier?
Yeah.
I am shocked myself as a professional to keep up with the market.
I think we said 30% increase in
Yes.
rentals. That was so thinking about it this way, you're owning something that is valuing, the value is increasing 30% as opposed to renting something where the rent increase, where that money goes nowhere, is
Garbage.
increasing 30%.
Garbage.
And what would you rather have? Stability in your 30-year fixed mortgage, or would you have a rental, right? A rent that you have to pay that's going to go up 30% with no control. So you asked the question before, is now a good time to buy a house? I think it is. I think it always is a good time. We've never done a mortgage for somebody that called us back and said, I'm not happy I bought a house, right?
Yeah.
I've never had that happen. So,
Absolutely.
and we do a lot of mortgages. So it's for that to be the case, that tells you something.
Absolutely.
You know?
I think it's also going back to the energetic, mental, and emotional alignment because not everyone is ready at all times, right? It takes time for you to get ready.
Right.
It takes time for you to prepare. And going back to, let's say, how do you begin as a first-time home buyer? How does one begin? Let's say someone made a commitment and stated, you know what, that's it. I am done renting. I'm done wasting money in the garbage. Right now it's time for me to start really focusing on being very, very consistent with my income, very consistent with my savings, no more clubs, no more, going out, no more, really this, waste of money on things that I don't need. And for me personally, I have to honestly tell you now, when I go shopping, I look at something and I say, do I want it?
100%.
Or do I need it?
100%.
And if the answer is, I need it, only then I'll be like, I will actually use this? Or is it going to be just hanging in my closet or the shelf and I'm never going to end up using it? Because my brain is so trained right now and conditioned with all the clean outs that we do, right? I'm like, is this going to one day end up in a dumpster or is it something I'm going to enjoy?
Right.
So if it's automatically, it's going to go to the dumpster. So I'm putting it back and I'm not touching it. But if I get excited, of course, I treat myself and I buy it. But going back to why people really should be very conservative with their spendings, and it reflects back to their spending on the credit cards and their credit.
You see the clean out. We see the credit card bills. So that's the difference for us, right? We see it on paper and they see it you see it in their houses.
So how important it is for one to start with the credit?
They should. The first step that any first-time home buyer should make is call a lender. Okay, that's the first thing.
Even if they're not ready.
6 months before.
Even if they're not ready, right? Because what we're going to do on a pre-approval is we're going to analyze everything. We're going to look at all their documentation, including their income, their assets. We're going to run their credit, which is the most important part. So you want to do that as early as possible because sometimes you have things on your credit that just show up that you're not aware of them.
Sometimes there's mistakes.
And there's mistakes. And you want to know what? If you get pre-approved and then buy a house immediately or go into or try and make an offer on a home, but there's something wrong with your credit and you didn't have time to fix it, it could adversely affect your deal. Okay. Whether it be in rate, maybe you don't get approved at all, but it's very, very important to get your credit run up front. Let us analyze everything. Let us look at your assets. Let us look at your income. Let Sam and I ask you the right questions because that's the most important thing. Sometimes if you go to an online application and just fill out an online application, they're not digging into your finances. They're just looking at a computer version of it and saying, yes, this looks good. When we review a file, we dissect it. Okay, we're dissecting it. I'm asking you every question. Okay, you make $100,000 a year. How do you make it? Are you salaried? Are you W-2? Are you 1099? Do you get commission? Do you get bonus? It is very, very important. All of those pieces of this of your mortgage application are different as far as your income, right? So we have to make sure that your income works, right? So yes, if you have a job and you only have 1 year of being at this job and you get a bonus and the bonus is half your salary, is half your income, well, we may have an issue with that because you only have one bonus. So most of the time we need a 2-year history. Need consistency. Commission employees is the same thing. If you're commissioned, we have to look at a history. We can't just look at, okay, you just started working, 6 months and you made, whatever it is. We need a history. Usually it's 2 years. Sometimes we can go 1 year. It depends on programs. But again, it is so important for us to ask the right questions and to analyze their application and make sure that we're giving the right information to the client and also to you as the realtor. You want to know, you don't want to waste your time, right? So if they come to you and say, hey, listen, I want to buy $1 million house, and I look at it and I say, you know what, they can only afford about 700. I don't want you to waste your time.
Absolutely.
I don't want you running around with these people and looking for,
of course,
and get their hopes up.
And get their hopes up. And, it's very important. So, it's the pre-approval process is very, very important, and it's a big first step that home buyers should make.
My thing on it is I always tell people, like, what do you have to lose, right? We do a soft credit check. So we're not even hitting your credit. It's just a conversation. We're just having a conversation. Why isn't that something you wouldn't want to do 8 to 6 months prior to you purchasing a home? The biggest purchase of your life. And you're not going to have a conversation with somebody that has no negative outcomes. It's only positive outcomes, right? You're only going to find out information that's either going to help you or it's or we can fix it.
Correct.
So I don't understand why people are so hesitant. For all the viewers out there, like, I don't get why, you wouldn't just call someone and have a conversation. It's just a conversation.
It's free of charge.
We don't charge you to call us. We don't do any, right? It's
Right.
We're pretty much working for you before we're even working for you.
Correct.
So it's really
What was the lowest credit score ever you've seen people were able to get a loan, and the highest credit score? I want to educate people
a loaded question.
on the
I actually have
lowest
some money.
and the highest scores you've ever witnessed that people have the ability to get a mortgage.
Can I tell a story? I want to tell a
Yes,
story
please.
of my lowest. Okay, and I think it's my lowest, but we're going to say that it is my lowest.
Mm.
Okay, so I had a couple. They were buying in New Jersey. I pre-approved them probably about 6 to 8 months in advance. They went into contract. Everything was fine. It was new construction, so this was a good 6 to 8 month process. So it comes game time, and we're within about 40 days of closing. The credit expired at this point, so we updated the credit. When I updated the credit, the wife had 2 60-day lates on 2 credit cards. So she went from a credit score being about 750 down to about 525.
Oh my gosh.
Yes. So what we were able to do on this, okay, believe it or not, is I was able to close their loan, because on an FHA loan, FHA does not have their minimum credit score really is 500.
Wow.
So you can go that low on an FHA loan. However, you can't do maximum financing. Maximum financing maximum financing is 10% down at that credit
90
score.
LTV at
Anytime you're under a 580 FICO score, you have to. So in any event, this couple, I was able to get them a loan because they were putting a big down payment. They were putting down like 40% or something like that. But we were able to overcome it, get them closed, and then after closing, we worked on getting the wife's credit fixed, and we refinanced them within a year. But again, if I can. And we can do low FICO scores. It just has to be the right scenario.
So the low FICO score, did it affect her mortgage payments?
Yes.
Absolutely.
From 500 to 700, how significant were the difference in monthly payments?
Well,
I want our listeners to understand
yes.
that financial bad behavior that doesn't very well measured, properly executed into life as grown-up adults.
Yep.
Right? This is not a monkey game.
How we don't
Credit affects everything we do.
Yep.
From buying a car to getting mortgages,
renting a place.
Okay? So I just want our listeners to understand that we want to be very clear. Those that are buying, good luck to you. Please make sure you watch your spendings. We even joked around about it, that we're going to confiscate your wallet with your credit card.
Give me the credit card.
All right? We will take the credit cards away so you go on financial diet, right? No spending. You go to work and you go back home. You cook at home. You sleep. Back to work. All right? Until you buy a place. After that, it's on you. But we will be able to direct you into the light where you need to be. But going back to those that are playing around with their not paying on time or maybe late, I want you to really explain to the public how significant it is to be responsible for your bills and payments. Because when we get there, let's talk real, okay? Every single one goes back home, and what do they do before they enter into their home? They look at their mailbox. You look at the mailbox, what do you do the first thing? You get the mail. And then sometimes it's a lot and sometimes it's nothing. What do? Holy shit. You drop it on the table. Some people open it right away. Some people don't open it for months and months. And sometimes people don't even know that they have piled up certain bills and payments that they're responsible for. But how is it non-payment or one payment or 2 or 3? How is it affecting the credit, and how the credit then affects their ability to get a good mortgage rate and the payments for the rest of their life?
So credit is a very, very important piece of the mortgage process. That is probably one of the biggest factors of your interest rate. So The higher your score, the better the rate most of the time is going to be, and the lower your score, the lower.
What does the highest score represent?
840 is I believe the
What does
highest.
it mean in the mind of the financial institution? What is it?
It means
what
you
is
have a
it?
good credit card. I mean, sorry, a good credit.
Good financial
yes.
behavior.
It means that you take care of your bills and you're responsible. So
Correct.
like there's on your credit, not everything shows up on your credit, right? So there's some bills that are very, very important that you should never be late on. One being your mortgage, obviously, if you're not a first time home buyer. Two, being rent. If you are a renter, you should make sure you pay your rent on time. Some programs require you to prove that you pay your rent on time.
Yep.
Not every program, but some programs, especially on the jumbo side. The jumbo side usually requires a prior housing history. What that means is they want to make sure for the last 12 months that you paid your rent on time. Okay.
So wait. Going back to the squatters and every single one of the things that with New York's ability to excuse the tenants and allow them to stay there for X amount of time. So you tell me that landlords have the ability to look at the back history of the rentals
Yes.
and mess them up if they didn't pay?
And report late payments to the credit bureaus.
How?
Some landlords.
How? Share that.
Experian, Equifax, TransUnion, right? Your landlord could report that to those bureaus. So that could be a blemish on your credit report.
Wow.
Definitely
This is
possible.
huge.
It's not common, but
Not common, but they can.
Good.
So
Or if you're in a
landlords could
bigger,
report.
yeah, or a bigger building, a bigger management company, they probably would, more so be able to do that than like a single, family, someone that owns a home that you're renting it from.
That's a great, valuable information because a lot of landlords that are listening to us right now are struggling.
Yeah.
And a lot of tenants are taking advantage of landlords.
Mhm.
The previous
Yes.
episode I had here with Willand, where we spoke about, how we have to pay people money to move out. Because waiting for 6 months or a year with New York City laws,
Yep.
it's not something that is fun to do.
Yep. It's your report. Your credit score is your report card, right? It's like showing the bank, hey, look how good I am at paying my bills on time, right? And when you come to the bank with a good credit score, now you're opening up the floodgates for you to get more options, right? More
Awesome.
programs. You're getting a better interest rate. Instead of you coming to them and begging, you're telling them what you want, right? You have a better credit score, right? You're coming to the table with, hey, I'm a really good person at paying my
Candidate,
bills. I
right.
have a good history, and now what can you give me? What can you offer me?
Awesome. So now going back to the difference between pre-qualifications and pre-approval, because I'm going to be honest with you. When I get pre-qualifications, and if it's my listing, and if a broker sends me pre-qual and not pre-approval, do you know what I do?
Garbage.
I rip it into pieces and I put it in garbage.
You should.
Then I call the broker and I tell them, hello. Do you understand the difference? And a lot of people don't. So please dive deep into the difference between pre-qualification and pre-approval because I think that's major.
Yeah, I'll go into it a little bit. So a pre-qualification is something that a bank can give you just based on a conversation, right? That would be like me asking Pete, hey, what do you make per year? Not really, like Pete said before, we're going to dive into it, right? We're going to see how long you've worked there, how you get your income, how is your income derived, right? Are you self-employed? Are you, W-2 earner? They're going to simply ask you, how much do you make a year? What's your eye color and what's your hair color? And here's $800,000. Here's a pre-qual for $800,000. That's it. So if I'm a borrower, right? Does that sound like the right thing? You're about to go spend every weekend looking for houses,
No.
right? You're going to go with your real estate agent. You're going to look at houses. You're going to find this beautiful house you love. You get into contract, and all of a sudden you can't get financing.
Right.
Why on God's green earth would you want that?
Right.
I mean, I don't know about you, but I would want to be prepared. I would want to have that conversation, right? So a pre-approval, right, is exactly what Pete said before, right? It's diving into all of that stuff.
Financial data.
Exactly. Doing a soft credit check, going through the motions, right? Show us 2 or 3 most recent pay stubs. Show us your tax returns in some cases, not all the time. Show us everything you have going on. Bank statements. Are there any large deposits? Right? Did your uncle just give you $30,000 that we can't use? Right? Things of that nature. So we look at all that, right? All those things are huge hangups when you're looking to buy a house. People don't realize it because they think, hey, I have the money. I have a job. I'm going to be able to buy my house. They might have had that job for 1 week. Right? And before that, they didn't even have a job, right? Or they have, so, and again, the credit plays a big part in that. That's why we do a soft credit check, because we want to see what's going on there.
Jobs, how important and what is the back history that you guys looking at? Because going back to COVID, right? A lot of people lost their jobs and there was big gaps in between. Even until today, right now, I'm getting phone calls from borrowers that are looking to buy, let's say, a co-op. And you know what, co-ops, it's more complicated than
Definitely.
regular home. So sometimes people tell me, hey, I lost my job, but then I was transitioning. Like a true story, a person was working for JetBlue for a very long time. And then JetBlue relocated from New York City into Florida's market and fired lots of employees. So that person completely shifted her career and she is now working for a hospital. Okay. So, but she wants to buy a co-op. So, but there was a big gap in between the time she left JetBlue and now she's working for the hospital. So that transition period, a lot of borrowers do have these gaps or sometimes unemployment, like because people lose jobs, right?
Yep.
So how does banking industry looks at this type of borrower?
So if you have, you can have a gap, okay? It's just depending on how long the gap is.
Mhm.
So like if you take a job and you took 2 months off because you just wanted to travel a little bit, that's fine. There's nothing wrong with that. We're okay with that. It's when you have more than 6 months that becomes a little bit of a problem. Then you have to be back at work usually for about 12 months, sometimes longer depending on the program. But if it's explained, like if we can explain it, like you on medical leave, like something happened to you, you had a life event, we sometimes can get past that. You know, we underwriters and banks, we're human beings as well. Yes, we have guidelines and we kind of have
So
to
there's
stick to them.
exceptions.
But you can get around it a little bit. If it's a certain situation and it makes sense, the person was out for a reason and now they're back and the income is consistent, because that's the most important thing, Olga, is the consistency, right? Underwriters want to see consistency. They want to know that they're going to be receiving income for the next 3 years. They kind of want to look at their previous history to see where they were and see where they're going. So they do look at a whole bunch of information. On a mortgage application, we only look 2 years back. So in order to apply for a mortgage, you have to have a 2-year work history. Okay. Now let's take some exceptions to this. What happens if you're a student, right? Let's take a student. Guy just gets out of college. He's been working for, let's call it 4 months. Okay. Let's say he's only working for 1 month. Okay. But he's got a W-2 salary job, makes $120 a year, $10,000 a month. I can use that income to qualify that person because they have a 2-year history. Their 2-year history includes education. So if you go to college and you graduate college, this is very important. If you just graduate college and you have a full-time job with a W-2 income, you can get a mortgage as long as everything else falls.
So
into
someone
place.
graduated college, got a job today, they could buy a house within 3 months?
Correct.
Correct.
As long as they're salaried. So they have consistent.
W-2.
It's got to be
Not
W-2 and salary.
So if you're hourly or salaried, you still get a W-2. That's the biggest misconception. You get a W-2 no matter if you get paid hourly or salaried.
Not 1099.
1099,
1099
different
is a different
story.
story.
Yes, but if you're salaried, the reason why underwriting looks at that and says, okay, you're going to, for some odd reason, I don't know why this is in the industry, but they would rather see you be salaried almost than hourly, right? Don't you kind of feel like that's...
They do.
You know, because the thing with hourly is it can be variable. It can fluctuate. Salary is a salary, right? It's set every week, every month, every year.
So it's stable.
Stable.
Stable. It's the same amount. So when you look at a pay stub, like in that scenario that I just painted, it's $120,000. So let's say they get paid on a monthly basis, right? It's $10,000. They get a check every single month. Every single month they get a check for $10,000. An underwriter loves that. That's consistency. I know he's making $10,000. He's got a salary. It's going on.
Easy breezy.
When you're commissioned, that income goes up and down. 1 month it might be 2, 1 month it might be 20, 1 month it might be 3, it might be 14. It goes back
So
and forth.
1099.
So 1099 is a whole different animal. We're going to get to that one. Let's finish up this one because I want to get to 1099 because we do have to expose that one as well. Okay. So
Absolutely.
So commission is just harder because the income fluctuates, right? So what we have to do there, as I said before, we have to average it, right? So if you're working at a job for 5 years, I'm going to take your last 2 years of your commission and we're going to average it. And that's how we're going to calculate your income and how we're going to qualify. Now, there's exceptions to that. Like say someone got a promotion or last year was just ridiculous and they're consistent this year already. We're already through March, through April almost this year, right? So we can look this year and see, okay, they're still making consistent money. So maybe we back out the previous year and just use last year and this year. So it's not a complete set way. We can go outside the box a little bit, okay? Now, let's get to 1099. You're very excited about 1099.
You don't want
Nah.
to?
I want to...
So 1099 is really self-employed, right? So when you're 1099, you are self-employed. You may have the same job as the guy that's sitting next to you at a company, right? He's W-2, you're 1099. However, believe it or not, the bank considers you self-employed. So does the IRS. They consider you self-employed.
And you should treat yourself that way.
Yes.
Because you are.
So there's many benefits of being 1099, as you know, because you're 1099.
Right.
Right. So you get to write off your income. So when we calculate
Expenses.
expenses. So when we look at your tax returns, okay, so we have to look at your tax return. We can't just look at your 1099 and say, oh, look, she made $1 million this year. We're going to qualify her off of $1 million, right? No, we have to go into the $1 million. We have to go into your Schedule C on your tax returns, and we have to see all the expenses that you put against that $1 million.
Which usually are a lot.
Which usually could be a lot. So let's say you wrote off half of it. So now you have $500,000 as income, and that's what we can use. But again, it's a 2-year history. So when you're 1099, we have to use the actual Schedule C on your tax returns and average it for 2 years. Okay? Treated the same way as self-employed. If you're self-employed and you own a company and you get a K-1, it's going to be treated the same way. We're going to take a 2-year average of your income that you netted, not your gross, your net.
Net after deductions. So anybody out there that's listening that is 1099 or self-employed, if you are planning on buying a home, call a mortgage guy immediately and dial back the deductions a little bit. So you're going to pay Uncle Sam a little bit more, but it's going to help you to purchase a home.
All right.
Just the reality.
It pretty much could be varied year to year, so they don't have to stay consistent to what's expected of their ability to.
That's okay. That's okay. If it's variable, that's fine. It's just a matter of what the deductions are in there. If, like Pete said, if you made $1 million and you deducted more than half of it, whatever you deducted, you only have what's left over to use for your income to help you qualify for the house.
Well, I've had a lot of people that actually got 2, 3, 4 jobs throughout the year just to kind of like step up their income for that particular year until they buy a home. And then they completely could transition into anything else that they like to do going forward, as long as they are able to keep up with the payments, right? And
Can I just comment on that?
Yes, please.
So people that have multiple jobs, okay, it's okay. You can have multiple jobs, okay? But if you have multiple jobs, you again have to have a history, right? So they can't be like, I'm getting a job, I want to buy a home next year, I'm just going to get a second job.
Mm-hmm.
That may not be okay. We may not be able to use that income, depending on how that income is. If it's consistent and you're getting it, you're getting consistent income, it's more of like a salary on a second job, you probably could use that if it's, probably has to be at least 12 months. 12 to 24 months is really what we require in a second job. The guidelines really are 24 months, but sometimes they will accept 12 months. Okay, so someone just going to get another job, a second job, may or may not work. Again, it's very important to speak to a lender or a loan officer just to guide you through this process, right? Let me help you. Let Sam help you on giving you advice on how you can be a homeowner, give you some pointers where you should go. So it is. You can get a second job, but you just have to do it right.
Nobody would do this, but really you should be calling somebody 2 years before you're going to buy a home. Nobody would do it, but it would make sense.
So to prepare to buy a home, can you officially say that it would take someone who is not a natural born person with a silver spoon, right? That's gifted to them from the family. And so someone who starts from ground zero and step by step is building their wealth and really watching their financial behavior to be consistent. How much time do you believe for a first-time home buyer would it take to prepare to buy a home?
It would take a couple of years. I mean, right? It depends on how much they can save up, their income, right? I mean, but like I tell everybody, you have to build your team, right? You should have your accountant, right? You should have even if you don't make much and you're just a regular Joe Schmo, you should have an attorney that you might be able to call, run situations by. You should have a mortgage person, whether or not it's your primary. Now you want to buy an investment property. You should have people in your court that can help you in life, right? These are what those professionals are for. And it just makes sense to have those conversations, right? Even an attorney, if you had an initial conversation with them, I don't think, right? And most attorneys wouldn't charge you up front to just have a conversation, right? Get to know that person. And it just makes sense. It's a long game, It's not like you're going to just overnight be able to buy a house.
So every single person that calls you, is there like different programs you guys have? Or is it one program that is cookie cutter for all borrowers?
Are we all cookie cutter?
No.
Nope.
No.
But that's why we ask questions. Sorry to cut you off, because I was going to say, I know he's going to say that, but the key is asking questions, right? Letting the people tell you what they need, what they want, what they're looking for. Pete's really good at that. He sits there on the phone sometimes for an hour, doesn't say one word to a client. Not one.
You got to listen.
And it's because the person is talking and letting him,
feel everything out.
Right. Awkward silence.
And being honest. Remember we spoke about it.
Right. Awkward silence can be uncomfortable for people. So sometimes we say more, right? We say more than we should.
Right.
So they start to tell us things that are going on, So But to answer your question, we do have a lot of programs, and the key is asking questions to see where they fit. It's like getting the puzzle pieces and kind of figuring out where we can put them.
Right.
You know?
So someone calls us up and say, "What's your rate?" Hey, Olga, what's the cost of the house?
Exactly.
It depends, right?
Right,
It always
right.
depends. It's the same thing with us. What's the rate? I don't know. I have to know your scenario. I can't give you a rate without knowing your scenario. If you want to have a conversation, I'm going to ask a bunch of questions, and then I'm going to analyze it. And I may not even I can give you a range of where the rates are, but until I really run your credit, I can't really give you a rate on what it is.
People think we're avoiding the question. We're not.
Mhm.
We just don't have enough information.
So each person qualifies exclusively, case by case basis, based on their financial history,
Mhm.
based on their down payment, based on their credit.
4Cs, we call it.
Yep.
Credit, capital, cash,
Compensation.
compensation.
What about reserve? What about reserves?
That doesn't
Cash.
matter as much. Well, that would constitute toward cash, but that doesn't matter as much as if you're borrowing in the conventional loan limit, right? If you start to want to borrow $1 million, $2 million, $3 million, the banks are going to want to see that you have some liquid money left after you close on the house. But in a
wait.
typical transaction, first-time home buyer, Long Island, right? Maybe it's 800, 900, maybe even a little over $1 million. You're still okay to not have funds left over after you close, which we don't like to see because we don't want to close people and they're in their home and now they have $10 left in their bank account.
Wow.
But is that the
Does that
case?
happen?
Yeah, sometimes it does.
So people sometimes walk away from the closing with no money left in the bank.
Yep.
Sometimes we don't know how much money they have. They don't always give us every bank account. So, you have to be a responsible borrower too. Like you're buying a home. If you're buying this home and you have $100 left in your bank account after you do this, it's not very
Yep.
responsible. Like
Just because
you're
you can
buying a
doesn't mean
home,
you should.
you are going to spend money. Like you're
Right.
buying a home, right? You may need rugs, you may need curtains, you may need something. You may need to fix something in the house.
Correct.
You're a homeowner now. There's always something that needs to be done. So like
Absolutely.
going into a home with $100 afterwards is just not advisable.
It's a crime.
What happens if something breaks? How many times you get someone that buys a home and a month later, oh, this broke.
The boiler.
The boiler, this broke, that broke. You need to have reserves just as a human being.
Emergency reserve.
You need to just be smart because if you spend all your money on it, you're going to be house poor. You don't want to be house poor. You want to have a little bit of extra money on the side and then be able to afford it.
But that's not for us to say, right? We're not to, if you want to buy a house and you can afford it and you meet the guidelines and you're okay with that, that's totally fine. We'll do the mortgage for you. That's absolutely fine. That's not our place. Again, back to having your team. That's why you kind of want to have a financial advisor, right?
Correct.
Somebody you can run these things by. Even if you have $5 in your bank account, you want to have these people that can guide you, right? It's funny because I at my house, I need to get my bushes sprayed for mites, right? This guy wants $2,300 to spray my bushes. Think about that, homeowners, or future homeowners. If you don't own a home yet, $2,300 to spray the bushes.
That's a
in the
lot
front
of
my house.
money.
Just to spray the bushes, right? So like, think about that concept, right? You have a hot water tank, you have a central AC system, you
Yeah.
have. So it does add up, right? Not trying to scare people, but you just have to be prepared for the purchase, right? There's a lot of things out there that can go wrong with a house. Owning property is not cheap.
And this is why we will unfold right now the most important topic, right? The topic that I really got so excited about, especially for those that have already made an investment, let's say 10, 15, 20, 30 years ago, and now they're sitting on their apartments or houses where it built up tremendous amount of equity. Potentially, some of those homes could be completely paid off, and some of these homes have really great equity.
Yep.
And some of them don't even know what they have. Because if you haven't spoken to a local realtor who gave you the latest assessment on the equity assessment on your property, right? How do you know what your property is worth? Just because your neighbor sold it for $3 million doesn't mean that your home is worth $3 million. More or less, it could be equivalent, but it all goes back to the size of the property, the condition inside, and many other factors, right? Some people just have everything brand new, completely got renovated, from electrical to plumbing to bathrooms to kitchen. It brings it into completely whole different appraised value,
Yep.
right? But now speaking to those that have been in their homes for a while, and now it's time for them to step up, but they are short on liquid cash. So how do you transition this type of clientele? What do you have to offer?
So it's a very good scenario, and this scenario exists a lot in the Metro New York area. especially with the high appreciations that we've had here. So like you said, someone bought a house, they may have bought it 20 years ago, and now they're sitting on $1 million in equity in this property, but they have limited funds in the bank. Maybe they only have like $40,000, $50,000 in the bank, but they either want to upgrade or they want to downgrade or they just want to move in general.
Right.
Okay. So we have a product and it's something that's kind of new. If you're older in this business, you know it because it used to be very, very popular, and it's called the bridge loan. Okay. So what is a bridge loan? A bridge loan, the way our bridge loan works is if you have equity in your current property and you're looking to purchase a new one, we will give you a mortgage on your current property. We'll either file it as a second lien or a first lien. Okay. It will be for 120 months, which is 120 weeks, which 120 days, which is 4 months. Okay. There's no payment actually due on this mortgage. Okay. So we collect all the interest at the closing. So you take the money that you make from you take the money that you get from the equity. So say you get $500,000, you take the $500,000 and in the bridge loan, you move that money and use it as a down payment toward the new house. So now you have a down payment on your new house, okay, from the equity in your property that you own already, okay? You don't have to sell it right this second. However, you do have to sell it in 120 days.
So technically within this 120 days process, there is a lot of moving the puzzles.
Yes.
That's supposed to really happen. I will honestly tell you, I really do not see how you and the borrower could do this without our help.
No.
I'm being honest.
Without a real estate agent.
No, we
Yeah.
cannot
No,
do it without a real
absolutely.
estate
It
agent.
takes a team, definitely.
Yes,
Definitely.
it takes a team. And when you mentioned right now that it takes 120 days in that transition, so technically a person's supposed to put their home on the market.
Right.
Correct. They should put their home on the market. They don't get that money though. Let me just explain. They don't get that $500,000 until 4 days before they close on their new home. Okay. So the 120 days starts pretty much when you buy the new home. So you're not accruing interest on the property when you apply for that bridge loan. We actually funded 4 days. It's the same thing as a refinance. We funded 4 days in advance. And then we buy the new house and we transfer the money over as a down payment towards the new house. So there is the period of time, 120 days, that's when they have to sell their home. They have 120 days from that point forward to sell their home. Okay. And in New York, Olga, can we sell houses in 120 days here?
Listen, nowadays we have such shortage of inventory. I really want people to hear, I don't know how much more louder I could be,
Yes.
that we are selling out on everything that comes into the office.
Mm-hmm.
It's scary. Okay.
Fast too, right?
Very fast.
Like how long does it typically take? Let's say a single family home in Queens. How long does that take to put into contract?
If I'm dealing with a good, reasonable seller who's ready, willing, and able to move, doesn't need to hold back on their ability to vacate the home, and they are listening to everything we're telling them to do, within 2 weeks, you should be in the contract. Remember what I said? Within 2 weeks, you should already be in contract.
Mm-hmm.
Okay? Given the fact that, everybody plays along very well. Okay? And people are really cooperating with attorneys and accepting the offer. Within 2 weeks, you should be in fully executed contract. Within 30 to 45 days, you could actually close.
What's the difference? What's the difference on putting someone into contract from a single family home to a co-op? Like, what's the major difference?
Oh, it's a huge difference. Like with the co-op, you need to go through the board approval. So the process is getting more complicated, okay? Because you sign the contract, you have to take that contract, you have to file the application to make sure that it gets board approved. This space alone could take anywhere between 30 to 60 days, the process from the time you sign the contract to the time you get approved. And only when you get approved, hopefully by then the mortgage will be clear to close. I'm always keeping an eye. Make sure your loan is clear to close. Because when you get approved by the co-op, I am not sitting and waiting for your loan to be clear to close. Okay, because everything has expiration time on all paperwork. When I'm saying that, make sure you get clearance to close, not because I'm anxious to get your money and I'm anxious to close. Well, that, of course, I want to get paid after all this work. Right now, we calculated it took about 30 days, 60 days. Now we are into 90 days. So we're looking at about 3 months. Mm-hmm. But the process is the appraisal gets expired. The documents get expired. So everything that you provided to your mortgage brokers, everything gets expired within this process. So this is why, as a broker, my job is not to just put you in a contract and then just go party and go on vacations, right? I think that we are the industry that takes the least vacations because it's very hard to detach from your deals. My kids hate going on vacations with me.
Vacation's not even
Because
vacation.
vacations don't even exist because my phone is always next to me. And when I go to sleep, when I go to the beach, I go to the water, I come out and I'm back on my phone. And my kid's like, we are going to steal your phone. I'm like, no, you can't do that.
It's
Because
difficult.
people depend on me, right? When you get a client to do business with you, it's like getting married. Because you are looking in their eyes and say, I will take care of you until we split ways at closing. So I just want to be super clear. There's a huge difference between buying a house and buying a co-op. The process is totally different, okay? And you definitely need a very good guidance, a very strong, skilled professional who knows the process from A to Z because it is very complex.
Do you think it takes longer to get into contract on a co-op as opposed to a home?
Yes, because the borrower's attorney responsibility to run a very deep due diligence on making sure that they check the financials of the building, they read the offering plan just to understand the house rules, just to understand if they own the land or they are financing the ground lease. Sometimes people refinance, co-ops keep refinancing. How do you think the maintenance keeps going up? And this is exactly going back to the situation where I educate my clients and I tell them, look, I want you to pay attention. A building that has a very high maintenance, you will be stuck with this maintenance forever.
Never
Find out
gonna, it's
why
never
the
going to go
maintenance
down.
is high.
Okay?
That's what
Because
they should
they
do. They should
have
find out.
financial situations where the maintenance has to keep up with the co-op's budget. The budget comes out from where? The budget comes out from the shareholders of the building's corporation, individual owners of the individual co-op. The money gets pulled into the budget, and that's how the money gets floating into all the capital improvements of the co-op buildings. I mean, you and I can go very deep into that,
Yeah.
but
Today's
people will get
times-
dizzy.
Today's times it's tougher than it's ever been for co-ops and condos. We didn't really talk about condos, but they kind of when you talk about maintenance and capital improvements, I think they kind of fall in the same category. And guidelines have changed a real lot because we had some episodes in Florida a number of years ago where a few buildings collapsed, and that's when guidelines changed drastically on co-ops and condos. So in New York, we have something called Local Law 11.
Correct.
Okay? So Local Law 11, any building that's 6 floors and above, they have to, every 5 years, they have to get an inspection on the facade. So what does that mean? They got to set up the scaffolding around the building. They got to have an engineer or an architect or someone that's licensed to go up and review, they inspect the entire building. Now, if there's any deficiencies in the building, now what they do is now they write up a report. You have deficiencies on this. So they have to come up with a plan. It's called SWARP. Okay, it's an acronym. And basically what that means is they have to come up with a plan on how they're going to fix this. So they usually, the time frame is a little different, but they have to get this fixed. They have to come up with a budget. They have to come up with a time frame, and then they have to execute it. If they don't execute it in a timely fashion, or if the deficiencies are too bad, they will actually deem the building unsafe. So when the building is deemed unsafe, it's kind of a kiss of death in financing, okay? It's not the absolute kiss of death, but you're going to feel pain, okay? Because most of the time you can't do a regular
Not
Fannie Freddie loan.
mortgageable.
You got to go into like some sort of portfolio product. We actually do have a portfolio product that does take, Local Law 11 problems. It does take any sort of non-warrantable condos. It does go into that. But understand that these problems are coming up more and more because Local Law 11 is not that old right now. So these buildings are just starting to get inspections, and we're seeing it over and over again. So when they have deficiencies and they have to put up this budget, this goes back to what you were saying. They have to have assessments, right?
Correct.
So now in order for their budget to look good or for it to work,
They have
to hit assessments. What is an assessment? An assessment is something that is charged to every shareholder or owner in the building, okay, so that everyone can contribute to the deficiencies and help pay for any of these capital improvements. So what does that do? it makes it more expensive to own in a co-op and condo sometimes because those maintenances could go up. Now, good buildings, and I'm not saying buildings that have deficiencies are bad because you're talking about big buildings. So like it's expensive to go up there and look at all this. However, buildings that do maintain well, they have lower maintenance because they're budgeting for this. They know that in 10 years the roof is going to go. So let's put money aside for the next 10 years. So then 10 years we can go ahead and fix that. The staircase, the elevator, whatever it may be, they need to actually save money and do that on a monthly basis and make sure that the budget is right. And a budget is very, very important. We kind of joke around in our world like, oh, look at this budget. They could just kind of put whatever they want. But in reality, the budget is very important. If you're a shareholder, you need to understand like what's going on in the building. Is this going to adversely affect me in the future? And you said it before, attorneys will review. A good attorney, not all attorneys, a good attorney will look at the minutes. They'll look at the minutes from the meetings. They'll look at the financials. They'll do a deep dive. Even Google it. Sometimes you could just Google it and find some things that are on a project. So it's very important. It's important for the home buyer and also for their attorney to do all of that due diligence on the building to make sure you're buying in a good building.
What a lot of people don't understand from our perspective is that not only are we approving the borrower, we're approving the building.
Yes.
So there's a two-step approval process.
The building is sometimes harder. The building is sometimes harder. A lot of times it's harder than the borrower because if there's any sort of deficiencies. I have a building I just did in Queens. It's a condo. I mean, I thought it was a slam dunk, and it turns out that they're doing a project that's $700,000. They're doing some facade work. They're doing a new roof. I was able to do this loan, but I want to tell you, I went through some pain. Like it just wasn't a quick turnaround. I had to get the management and company involved. I had to get a letter from the architect that on what the status of the project was, because it was already 4 months in. So I needed to get a status of what was going on. What did they complete already?
And hopefully the management company and hopefully the property manager will cooperate and respond to your phone calls and emails.
That's a big if.
So all the management companies out there, be nice to us. We're just trying to close loans.
It's true though. It's become so difficult. Those are the things going on behind the scenes.
Of
for
course,
us. People think it's easy breezy.
All we're trying to do is close a deal.
That's it. And all the person's trying to do is own a home.
So the borrowers, when you ask me a question, the difference between regular residential homes and the borrower on a co-op, right? Mm-hmm. Let's dive deeper into that.
Sure.
The borrower, for me personally, I have to make sure that the offer gets accepted by the owner. Then I have to make sure that the appraisal passes, and then the value that we are marketing the property and getting the property represented on the market at the best possible comps, the latest comps, that it gets accepted by the appraisal on its actual value based not only on the building but the neighboring comps, right? Yep. Then I have to make sure it gets approved by the board.
And the board package?
So
anybody out there that does not use a real estate agent that is trying to sell or buy a co-op is out of their mind.
Absolutely.
And I'm not just saying that you are out of your mind. And I've seen it many times again.
Absolutely.
You could be, if you want to do a for sale by owner and you're selling your own co-op and you're listing it, you have no idea what the board is going to approve, what they're not going to approve. And a lot of times agents have a relationship with the management company.
Right.
So it helps the process. Like we said, it's a big if they're going to answer us. A lot of agents have a relationship with them.
Absolutely.
So it definitely helps.
Listen, Douglas Elliman, the company that I work for and with, they run a lot of buildings.
Mm-hmm. You guys have a
management
company.
We have a huge management company. So do you know, when we trying to get a co-op, the first thing we do is we reach out to the manager company, property managers, and we build that rapport and connection. If it's a repeated business in the building where we do a lot of business, we already know the names. They know who we are. We know who they are. And they know exactly how we operate. I had a conversation yesterday with one of my very, very old clients that bought an apartment with me years ago, and he's now on the board. And when he sees me come and showing the properties, he says to me, Olga, when I go to these board meetings, I remind them what you did to me when I was buying my co-op. You set me down at the bench outside of the building and you said to me, show me your bank statements. Because without seeing the bank statements and knowing for sure that he has the money and he has a good credit, I would not even take an offer.
And then you said, give me your wallet.
And that's a joke, but yes, that's a joke, yes.
Just
but
for the credit card.
You're
You
right.
just
Just for
want to
the
make sure.
credit
you're
But
not
I
spending
do
on the credit card.
train my buyers, and I do train my sellers what to do and what not to do, how to behave and what not to do, because the behavior throughout the whole process could definitely harm them on the way. And I really monitor very carefully to the point where we stay consistently in contact with the seller, with the buyer, just to make sure that everyone is on track.
Yep.
So, for all those people that are looking to get a broker to represent them to sell their property, I would say that if you are local, please reach out to me and my team. And of course, my company will be very happy to represent you. But those that are not local, please understand that we also represent sellers and buyers in different states, right? Speaking of financing, how many states are you guys in?
50.
50
Yeah.
states.
And Puerto Rico.
Amazing. So that means that if any of my clients sold today and relocated to any other state, not only we could help them relocate by designating them to work with another great broker, but you guys can also underwrite their loan, so it becomes a very easy process for them, which is a very quick transition as well.
And if they have equity in their home here and want to move somewhere else, we can still use that equity from the home here to help them purchase a home somewhere else.
So if anybody has a house in New York and they're looking to buy a house, let's say in Florida,
Mhm.
that's the very common bridge that we are witnessing, that people are going back and forth.
Definitely.
So we've witnessed over the years, North, South Carolina, Texas becoming very popular also for New Yorkers. California, a lot of people like to go to California.
Georgia.
Georgia. So that means that you guys are open to 50 different states to be able to underwrite the loans.
Right.
So if anybody has a mention, let's say in Great Neck or mention in Fresh Meadows or Briarwood, so they're able to reach out to you. You will do the careful evaluation of their existing home appraisal, right? And then you'll be able to guide them what to do going to the next chapter of their life in a different state. Obviously, we could work together hand in hand, collaborate constantly, and make sure that we designate the right business professional on the other side to make sure that they properly guide it. But it could be such a seamless process, right? Yeah. This is what I'm talking about. Like, it's having a white glove service. You know, I put on the white jacket today
Love the white
for that purpose, okay? We give you, to our clients, white glove service. My kids sometimes, and my grandkids sometimes, and our parents sometimes could be neglected for some period of time because we are eyes on the road with our clients, making sure that we're holding their hands and we are really not looking to the left, to the right. We just keep going to the point where they need to go, because otherwise there is no deal. All right? So what's one piece of advice you could give to someone who is starting off right now, who is maybe even thinking to start with 3 to 5% down?
My advice would be live way below your means. It is so important. We just talked about this before, right? You know, there are some people that make really good money and they live like they make really good money, which is fine. But at some point, you may not make really good money, right? So live below your means, right? So save a lot. There, you know, a lot of people talk about the interest rate. There's actually a percentage rate that you should be saving. That's the more important rate, the rate of which your income that's coming in, you're saving, right? That's an important number. My advice is know the credit game. Credit is a game. Learn the game. Learn how it's played. You're not going to beat the system. You're not going to get around it. Learn how a credit report is scored. You know, reach out to us. We'll explain a whole credit report to you. Have your credit in line. Save your money, and just keep the course. You know, I think it's not as hard as people think.
It's not as hard.
Yeah.
Peter, your take to someone who is maybe now going through a transition and sitting on that sideline where they may be pressured by the wife. Oh, honey, this kitchen is too small for me to cook tonight. Why don't we start looking at bigger homes? Oh, shut up. I can't afford more payments. So what would be one piece of advice you would give to those that are in that transition period and the wife potentially keeps pushing the husband to get uncomfortable?
Well, there's a couple different ways here, right? So we could help them get pre-approved and buy another home. We could use a lot of different ways of doing that. We could use a bridge loan. We also have home equity line of credits too. So they could take out a home equity line of credit on their house if they wanted to and use that as a down payment. That's also a possibility. Another thing that could be a possibility is, why not renovate the home? Okay. So what happens if you decide to renovate this home instead of buying a new home? It doesn't make sense to buy a new home. It's twice as much. It doesn't make sense. We have a nice piece of property. Let's renovate this home. So let's go.
Do you know anyone
I do.
who will be able to help?
In all aspects, I do. Okay. So in the lending aspect, right? So let's talk about this. So let's say that they don't have enough money to renovate their home. Okay. Let's say that they need money to renovate their home. There's what they call a renovation loan. Okay. A renovation loan basically gives you money for an after improved value of your home. What does that mean? That means that if your home right now is worth, let's call it $600,000, okay? You need to put on an extension because you want a bigger kitchen and you want to expand your upstairs and put another bedroom up there. The cost of that is $200,000, okay? As a lender, we will lend you the $200,000 to renovate the home. We're going to look at not what the home is valued at today. We're going to look at what the home is valued after you do the improvements. So let's say after you do these improvements, the home is now worth $900,000.
Mm-hmm.
We would very happily give you the $200,000 to renovate the home, to be able to do this. The only thing is that the bank is involved in the renovation process a little bit, okay? Because we distribute money. We don't just give you $200,000 in hand and you do your thing.
You don't?
No. Unfortunately, we don't. It would be nice if we did, but unfortunately, we do not. So what we do is we actually break it up. So we have milestones, right? So like, let's say in this scenario, let's say when they frame out the new home, the new extension, maybe they distribute $75,000 at that point. Then when you finish the kitchen or finish the floors, they give you another $50,000.
So you monitor.
So you're monitored a little bit. You have to milestones to get your money. Okay?
Is there closing costs to that money?
Absolutely. It's New York. There's always closing costs.
What is the closing cost on average?
It depends on where you are. And it depends on how much the taxes are, because when I say closing costs, I look at settlement charges, right? Settlement costs closing costs are just actually fees. Those are real fees.
Because for this program, you don't have title search.
You do have a title search on this. There's a title search. There's mortgage tax. There's usually an application fee. There's an appraisal. There's actually a consultant that's kind of like a referee that actually monitors the whole entire process after you close to make sure that you're doing what you're supposed to be doing on the renovation. So it's kind of hard to say, but I would say like on a renovation loan, you're probably in the 5%, 4 to 5% range. On a conventional loan, depending on where you are, you're probably in the 3%. And
you mean the closing costs?
Closing cost settlement charges. Yeah, it depends on the taxes too, because usually we escrow taxes, right? So like if you're in the city, it's not that bad. But when you step out to Long Island and all of a sudden your taxes are $20,000, it's a real number. So
You're being very generous, $20,000. I've seen 50.
I've seen 50 too.
More, yeah.
Yes.
Right now, Roslyn Harbor.
Yeah. 30,000.
Great Neck. Some areas of Great Neck.
Yep.
I mean, the taxes are really in some homes can escalate to $50,000 and up.
It's incredible. It's gotten so crazy.
Yeah, it's gotten so crazy. So you really need to be very mindful with your spendings and where you're putting yourself into. So, Peter, how many different programs that are consistent use of different requests with programs that we really want to share with our audience?
So, we have a lot of first-time homebuyer products. So let's go there.
So let's name them: first-time home buyers,
right?
Bridge loan, home equity
line of credits, regular conventional 30-year fixed.
30-year fixed.
There's FHA loans, which is a government-backed loan. They allow for lower credit scores and lower down payments.
Wow.
VA is a veteran's loan. So if you're a veteran, you get some really great benefits. Like you could do 100% financing on a VA loan.
Wow.
Okay. So they also allow their guidelines are very vast. So like you can have, believe it or not, like a 60 debt to income ratio on a VA loan, which is kind of crazy.
Well, because they're getting paid.
Well, it's a VA. We do the right thing for our VAs.
Right.
You know. So and I think the last one is like non-QM. I would like to touch on that just a quick bit. So non-QM, what is non-QM? Non-QM is outside of the box type of mortgages. It actually stands for non-qualified mortgage. Mm-hmm. So you are a 1099 employee, right? So normally we have to look at your tax returns, but on a non-QM, we could take your 1099. We can take 90% of your 1099. Your 1099, not your net, your 1099, 90%. Mm-hmm. Chances are you wrote off a lot more than 10%.
Correct.
We can use 90% and use that as income.
Wow.
Okay? If you're self-employed, okay, like a real self-employed, not the 1099's not self-employed, but like someone that owns a company, okay? Mm-hmm. We can take 12 months of their bank statements. We can rip out all the deposits in there and take 50% of that and use that as income. Okay. So we're not using tax returns. We're using bank statements to convert that over to income. Investors. There's a very, very popular one. We write a lot of this. Investors. Like if you want to buy an investment property and you don't show enough money, or you're just an investor, and a lot of investors just don't show good money. They write off a lot. It's just the way it is. We can do a no doc loan, a no income loan, and just use the rental on the property as long as the rental
is on the books.
Well, it doesn't have to be on the books. It actually will go if it's a purchase, we'll go based off of the appraisal. So the appraiser actually says what the estimated rental would be on this property.
Projected.
Yep, the projected, and we'll use that as the number to qualify them. So it's really on.
So you don't need existing tenant.
Nope, you actually
with the history, with the lease.
It could be vacant.
It could be vacant. Wow.
It could be vacant. If it's vacant, we use the market rent.
Mm-hmm.
If it's occupied, we're gonna actually use what the rent is that they're collecting.
Wow. With today's rental values, I mean, anyone who is looking to sell their multifamilies definitely should reach out and just to see what the home is worth.
Absolutely.
Because the values are just like improving wildly. And thank you, God, we live in New York City, which I can't complain about leads or volume of business. I think that in the end of the day, we all, we are where we are based on the networking and based on the people we know, right?
Yep.
So some people say like your income is based on the amount of people you know. So with that, I'm very pleased and very excited that we had the opportunity to have this wonderful podcast today recorded in the studio. And I would like to say thank you to all our listeners. Thank you for following us. Please subscribe to our channel. Please follow Peter and Sam. They are wealth of information. And if anyone is looking to buy or sell real estate, you know how to find me. Send me a direct message or just send me a quick follow-up call or email. You guys know how to find me. Thanks a lot, guys, for watching. And until next time, see you soon.
Thank you for having us.
Thanks for having us, Olga.
So we now